Hi, I'm Rachel McVeary, investing editor at US News and World Report, and I'm talking with the contributors to Advisors Corner for the Investing Experts Roundtable today about how to invest or maybe tweak your portfolio as we head into a probable season of interest rate cuts by the Federal Reserve. This is US News group of certified financial planners, advisors and experts, and some business owners as well, who write regular columns with investing advice for the investing section of US News website. This conversation is being recorded ahead of the official rate cut announcement, expected on day 2 of the Fed's policy meeting for September on the 18th. But the consensus among bond traders and commentators at this moment on September 9th is that there will be at least a quarter point rate cut, with the CME FedWatch giving about a 25 to 29% chance of a half point cut as of this morning. This would mark an end to the long hold on higher rate levels in order to tame inflation. And now that the labor market is softening, inflation appears to be cooling, and the economy still looks fairly strong, but perhaps still struggling against higher prices in some areas, it would seem a good time for cuts. So we're going to proceed with our discussion with the assumption that the rate cut is happening. I'm going to briefly introduce the advisors. We have Julie Pinkerton, chartered financial consultant and CEO of Evozen LLC and founder of Client First, a fintech platform that connects independent investment, insurance, tax, and legal professionals.
Yeah.
And we have Scott Ward, who is a certified financial planner who joined Compound Planning this year as a specialist in retirement transition strategies and portfolio management, among other things, and a national ambassador for the CFP board. Margarita Chang is a certified financial planner, member of the board of directors for the CFP Board of Standards, and founder of Blue Ocean Global Wealth. And Kate Stalter is a Series 65 licensed financial author and investing expert who's done everything from starting up an RIA to launching an exchange-traded fund advisory for Cabot Wealth Network. So welcome, everyone. So excited to have you all here. I thought we could have some fun today answering the most popular questions from across the web related to the upcoming Fed interest rate cuts that are expected and how that might impact people's investing strategies now, if at all. So I'm going to ask them just as they're presented online, starting with, how do I decide where to invest during rate cuts? So to me, that just means if I'm going to make some tweaks to my portfolio now, what should I be thinking about? And where should I be looking first if I'm going to do that? Kate, could we start with you on this one?
Sure, why not?
Great.
So, it is true, Rachel, like you were saying there before, interest rates do affect your investments, but I have to start out with the caveat of shuffling around your portfolio holdings doesn't always result in what you think it might in anticipation of some event like a rate cut. And we've got a few other events happening this year that people might also feel like they want to kind of shuffle holdings around. Really, the best way is just still my little caveat here. The intention is to always remain diversified. That way you get exposure to all the equity and fixed income asset classes, regardless of what's going on. Now, keep in mind your goals, where you are with your own investing. If you're close to retirement, you may be relying more on fixed income. So remember that the prices of already issued bonds, they rise when rates decrease, but yields go down. Pre-retirees and retirees should also hold some growth assets. I mean, in the past, it was, that growth stocks weren't really associated with retirees, pre-retirees. That's changed. That's part of a balanced portfolio. There are definitely sectors like tech does do better as rates decline. Real estate is one. There's a few others that, believe it or not, materials, industrial, some of the more boring kind of sectors. But all of that can help, lower rates can help stimulate spending, which benefits all of these different sectors. Tech benefits because its future earnings become more valuable. So there's kind of different reasons in each one. But there are some sectors, some of those I named are a few of those to look at if rates decline.
I'm glad you mentioned real estate because we just did a REITs ETFs story today. The interest in that is rising right now in real estate investment trusts. Anyone else?
Sure, I'll speak up on this one.
Okay, go for it.
Um, it's interesting because knowing that our audience is very diverse, and knowing that I'm clearly closer to retirement than anybody else on the panel, I want to speak from my perspective because obviously we've got a lot of folks that are they're probably a little bit more conservative investors as they get closer to it. And I think it's really important at this point to be able to, recognize that there's some easy opportunities by locking in some high yield CDs. We personally have peppered our retirement accounts with some CDs to be able to, lock in that yield very easily. We don't need the income right now, but if someone did, they may want to be able to, start looking at some of the other government bonds to be able to take a look at. And then another area that I think is particularly interesting is I'm glad you mentioned REITs because I do think that the whole housing market out there in general is ripe for a lot of opportunity. There is such a lack of affordable housing, and if interest rates are going to come down, obviously that will make many consumer loans, such as a real estate loan or a mortgage, much more attractive. And so a high volume builder like a Toll Brothers or a KB Homes could be an attractive, play and to be able to take a look depending upon, how conservative or persuasive you would like to be.
Great. And just to follow up on that, I mean, does the interest rate cut necessarily mean that the mortgage rates are going to come down? And in what situation maybe would that not happen?
from from what I have always seen is that they will eventually come down. There'll be a little bit of a lag because they'll want to see the trend. But for the most part, you should start seeing those reflect, especially depending upon what the mortgage loan itself is looking to as its benchmark.
Okay. And Scott, Rita, any input on the original question, how to invest during rate cuts right now?
So Rachel, I'll mention a number, 11.55. And the reason I mention that number is that following the last 5 times that the Federal Reserve has raised rates since 1995, in the 12 months following the time that the Federal Reserve stopped raising rates, intermediate bonds on average have gone up 11.55%. So
Wow.
while there's no guarantee that that will happen this time, what I am saying is that if you have a need, if you have a desire to incorporate bonds into your portfolio, this is a fantastic time to revisit that.
That's a great point. Anything from you on this one, Rita?
Absolutely. Thank you so much, Scott. So I was going to say, in this environment, a lot of people have robust balances in high yield savings account and money market. Like Julie was saying, this may be an opportunity, provided you have adequate cash reserves to lock in CDs, even build a CD ladder. In other words, have CDs of different maturities. The benefit is if you put everything in the short term, you'd have access and liquidity. If you put everything in the long term, you'd lock in higher rates. But by having a ladder, you can have the best of both worlds. And then in anticipation of rate increases, you don't have to do all this right away. A lot of people were very concentrated at the shorter maturities for bonds. So intermediate can be really helpful. And then as far as area stocks, the idea is that when interest rates are lower, it does cost less money for people to borrow money. So both consumer staples and consumer discretionary can be areas of opportunity.
Great, thank you.
Yeah,
Good
Rachel, if I
insight.
could add one more.
Of course.
I want to piggyback off of something that Julie brought up, and I thought it was very insightful from the perspective of, say, a retired investor or, say, someone who's just about to retire. I want to go back to just a few years ago, 2021. Think about it in that context when if someone owned bonds at that time, they were looking at forward-looking earnings expectations of around 1.5 to 2%. And so now we're looking at a period of time for the next 5 to 10 years of bonds probably having the earnings capacity of around somewhere between 4 and 6%. So for a pre-retiree or a current retiree, that's a game changer.
Great, great. Well, let's move on to the next question. Just we've touched on this a little bit already, but what are some of the best high yield investments? So this is what a lot of people are interested in. You know, what are the best ways to capture the high yield that's level we're already at as the rates appear to be going down? And wonder what circumstance would you want to do that? Rita, will we start with you on this one?
Sure. So as mentioned, 2022, the stock market didn't necessarily cooperate, right? We didn't see the most positive results. That's being very polite and diplomatic. In 2023, investors did experience positive returns. So right now, interest rates are still higher than they have been. So if you're a saver, locking in rates in CDs. And it's really important that everyone do like their research, because these rates are available to everybody, regardless of their age or stage in life. It's just some institutions might have higher minimums. So that's for everybody. The other thing is, if you are nearing retirement or even in retirement, you don't necessarily have to put all your money in one place, but there are very competitive rates on fixed annuities, and that might provide a pre-retiree or retiree some level of comfort knowing that they're getting, a guaranteed rate of return. And annuities do provide individuals and couples an additional source of, guaranteed lifetime income to supplement Social Security. So those are some areas where people can be looking to take advantage of these higher interest rates and lock in some gains or some guaranteed rates.
Okay. Scott or Kate, any other suggestions? Julie?
Yeah, one thing, I mean, there are some, and a lot of these have already been touched on today, like high yield savings account, CDs. I mean, some of these, they are pretty obvious, but again, it kind of bears repeating. There are also certain other asset classes that really can offer some higher yield. I mean, dividend paying stocks in particular, an ETF that tracks dividend stocks. There are many of these.
Yes.
We've mentioned real estate investment trusts, of course, and in the past month, the S&P real estate sector has been one of the best performers in anticipation of this rate cut. It's even held up on days when the broader market has been trending lower. So, and REITs, for the record, they're required to pay out 90% of their taxable income in the form of dividends. So you often do get a higher yield there. One thing that a lot of my clients have asked about in the past, and I do want to bring it up because I've gotten questions about it, master limited partnerships from the energy sector. Now, these do offer high yield. They aren't as subject to the fluctuations that you see in the energy sector because it's not as pegged to the underlying commodity, because they do have a steady stream of income. But I also just, again, I've always got these caveats about this. It's not a good idea to make a big bet on any one thing, whether it's an asset class, a form of investment, or the changes that you might see from interest rates. And the other thing too about MLPs, you can get ETFs of those as well to spread your risk. So it's all about monitoring your risk levels at any time, regardless of interest rates.
Wow. And I actually kind of surprised to hear that people are asking about MLPs. But
I've gotten some questions.
That's good
Yeah.
to know. That's good to know. Julie?
Yeah, I want to tag on to what Kate is talking about, because she's mentioned it twice, and I think it's something that we just always have to keep in the back of our minds. We need to always look at our portfolios from an overall perspective to make sure that we have the diversification, and that diversification and overall portfolio actually matches our real risk tolerance. Sometimes we think that we have a higher risk tolerance or a lower risk tolerance than we really do. But I also think that we're in a time period that is while there's always an uncertainty in the markets, we definitely have some interesting days ahead of us. The financial gurus out there, you know, really aren't certain which direction the Fed will go. We've talked about, typically we see a quarter to a half a point, change. And, the some of the materials I was seeing this morning was maybe it literally splitting that right down the middle because they're just not certain which way things will go. We've got a presidential election coming up with two very unique candidates, widely divergent, and their first presidential debate will be tomorrow night. And who knows, what that may change in the world. So I think overall, just continuing to reinforce that having a good diversification and keeping an eyeball on your overall investments is really smart, no matter what you choose to do for this period.
And that's such a great point with the CPI and the PPI reports coming out. And on Friday, it was a 50% likelihood of the half point cut. And this morning, it's 25%. So over the weekend, if people change their minds. So it's definitely not set in stone, as you're saying. So on to the next question. In the interest of time here, we've got a pretty straightforward one from the internet. Are rate cuts bullish? So I take this to mean, in other words, why does the stock market respond positively to interest rate cuts? And is there a situation where it wouldn't? Scott?
Well, it can be interpreted as a bullish sentiment because it typically means for companies that their borrowing costs could go down. The Federal Reserve typically lowers rates to spur economic activity. Lower rates, as we said earlier, tend to be good for bonds. So yeah, I think that a decline in rates could be taken as a bullish sentiment.
Okay. Could anybody comment as to when maybe it wouldn't be? Is there ever a scenario in history where you have a lot of rate cuts happening, but stocks don't benefit? Okay, that tells me no. Not off the top of your head, so we're pretty safe with that assumption. Okay, and so the next question was, what specific types of stocks? We want to know what stocks, right? Should I buy when interest rates fall? Or what about bonds? Now, if you don't want to recommend certain stock picks, that's fine, but sectors, types of bonds. Let's start with Kate on this one.
Okay. And I think I've kind of alluded to this a few times already, but it's fine. And you're right, Rachel, I am not going to recommend individual stocks. The sectors, tech and growth sectors are very well known to benefit from lower rates, and there's a few reasons for that. Um, Healthcare is one of those that kind of has different characteristics. So it could benefit just due to spending, but it also is a little bit impervious to rates because people are going to keep buying healthcare. And when I'm talking about spending, I'm talking about the companies themselves and capital expenditures. Okay. So that's one. Uh, High yield bonds, be careful about that because that does have the risk characteristics of stocks. So that's a few things just to consider in there. We did talk about real estate. I'm all about spreading the risk, and again, if there's it can be dangerous to lean too heavily on what you believe might happen and what the outcome might be. Now, historically, I think this is just kind of adding something Scott was saying a minute ago, is that historically, when there have been rate cuts, the S&P has risen in the subsequent 12 months. So we do kind of know that for a fact. But again, it's about sort of looking at some of these sectors that maybe have been a little bit beaten down. Consumer discretionary, for example, some of the stocks in that sector have not been performing well. Others have been, but some have not been. So, if there's a value opportunity, certainly that's something that investors might take advantage of when they're rebalancing.
Great. I just want to throw something in there. You mentioned the energy sector. Does anyone want to comment about what's likely to happen with utilities type investments? Have they kind of reached a top and are headed back down, or do they have some life left in them? Does anyone want to comment on that?
Well, the
Scott?
yields on you, yeah, they're competitive. I'm like Kate. I think if you have a little bit of everything, you're rarely disappointed when it comes to, the outcomes. I also want to piggyback off of something that Kate just mentioned a moment ago, and that is this is probably a good time if you're going to do a rebalance at any point this year. This might be a good time to consider a rebalance, for a couple of reasons. One, um, not to say stocks couldn't go up further. We hope that they do. Um, but if that part of your portfolio is overtaking the percentage that you typically would have it, and if bonds, are in a position to potentially increase in value, then this is a great time to sort of take a little cream off the top and reinvest in some other things that might have some upside potential with perhaps maybe a third of the volatility.
Yeah, less risk, right? So Rita.
Utilities or diversification investment in general. So, I mean, I can say that I think it's really important to be both strategic and tactical. So here's what I mean. You don't want to set it and forget it and never give your portfolio the TLC it deserves. However, you don't want to be day trading. So it's important to look for these opportunities, right? So with stocks, diversification with regard to growth and value, as well as capitalization. So if you believe that rate cuts are bullish and technology stocks and growth stocks benefits, it doesn't mean that you get rid of all the value. There's benefit to having value in your portfolio for diversification. And then we talk about fixed income bonds. There's diversification with regard to maturity and credit quality. So you don't want to go all out and have a high yield, have all your fixed income be high yield, because high yield bonds are more volatile and behave more like stocks. So it's just important to understand that this is an opportunity. If your 60-40 portfolio is now, I don't know, 64-36, maybe you want to take a look at that. And if stocks continue to perform well, that's okay. You still have 60% stocks. But if they're a little bit, volatile because of events, global events, domestic events, that's exactly why you took the opportunity to give your portfolio the TLC it deserves.
Great. So Julie, any thoughts on specific types of stocks, bonds, sectors, or whatever you want to talk about?
Yeah, definitely. From a more general standpoint, I've always really enjoyed, good blue chip dividend paying stocks and, companies that tend to do well, in this time period is like Kate mentioned, healthcare, and we've talked a little bit about energy and utilities. One area I do think that is very fascinating and continues to evolve is just the whole clean energy environment. Because when we look at, it encompasses so many aspects of everything that we're talking about, including utilities, including, big ticket purchases that tend to, go up when inflation and interest rates come down because the consumer exuberance and confidence for big ticket items, rises. But, we're getting a lot of mixed signals out there because about the time where we've got, abundance of EVs and a big push globally for clean energy, a lot of the manufacturers are really pulling back. I believe it was Ford who announced a 30% reduction in manufacturing for their EVs just this morning. So I think that there can be some interesting plays, taking a look at some of these areas. But again, going back and looking at them from various different sectors, such as whether it's an individual stock, an ETF, or some type of a dividend paying vehicle.
Great. Well, this discussion kind of leads into the next question, our final one. So up to this point, this has been a very generic sort of question. How do I make more money ahead of rate cuts? Right? It's a very greed-filled question. But my question on top of that is, by the time the Fed starts cutting rates, is it too late to make portfolio adjustments like these, or should you have done it, last month or the month before? It doesn't matter whether it's a quarter point or a half point cut in terms of the strategy that you're going to use.
I'll jump in. The answer, Rachel, is no. It's not too late. I feel like I'm on a game show. The answer is no. It's not too late.
You win.
Ding, ding, ding. There's never an event in the market that you have to get it at exactly that moment or before, or your potential for more gains are going to be wiped out. I mean, I said it a minute ago, is that it's actually been in the months following a rate cut that the S&P 500 has risen. I mean, Julie mentioned a little while ago that for mortgage rates, there's kind of a lag time there. So this will play out over months. And we've already mentioned, we have the presidential election in the middle of all of this. There's no single event, and we've seen that many times in our own lifetimes, right? There's no single event that so far historically has been, if you don't get in on that day, you're out of luck.
So what would be your takeaway then that you want everyone to know?
It's so boring, but it's just kind of what we've all been talking about a little bit on just rebalance, like Scott said, keep diversifying. Yes, look for opportunities. I mean, I may sound like I have some big problem with people picking some kind of overlay with sector or single stock. I don't. And that's fine. If an investor wants to do that, that's great. It's just always keep in mind. I mean, I do know I've worked with some people who kind of previously had just made big bets. Everything was always swinging for the fences. And I always just want to caution people about that there's no one thing here that's going to make that suddenly a great strategy.
Okay.
Yeah.
Let's go with Julie.
Kate, I think you said that really, really well. Like just like you said, a lot of this will play out, over the weeks, and as Scott said, I think this is just a really good time to be able to do some basic maintenance on your portfolios. Every once in a while, you do get these moments in which you have a significant reason to look at your portfolio, but realistically, if you've done the right thing from the very beginning, you probably already have a good structure in place, and it's more about tweaking things and catching opportunities when you can. Obviously, if you're going to go for CDs, it's pretty easy to be able to lock in some yields the day after, because you're going to know which direction the markets are tending to be able to move. Obviously, if things start cutting, you're going to want to probably pick up the pace a little bit. But otherwise, I think this is just a really great time overall to perfect some of the areas of which you started out with if you've got a really good solid financial plan.
Okay. Rita, what would your takeaway be today for everybody?
Well, my takeaway is it's never too late. It's important. This is exactly what I tell my clients. You don't need to rush and do something tomorrow because you're not going to experience FOMO. There's a difference between being haste and being swift, right? So sometimes people are loath to rebalance their portfolios because they're worried about taxes. But if you have to rebalance your tax deferred or tax-free accounts, there are no tax consequences. So start there. So yes, the takeaway is there's no time like present to look at your portfolio and give it the time, love, and attention it deserves.
Okay, and finally, Scott, any takeaway? We haven't talked about crypto or gold or just anything you want to talk about.
Well, I think it's right. There's never a wrong time to be fully allocated, in the market for long-term purposes. So if someone is sort of sitting on the sidelines and thinking about, well, maybe I've missed out on equity returns, let me give you some a little dose of optimism here. Not all stocks across the globe have gone up this year, nor last year. a couple examples, small companies here in the U.S. and mid-sized companies here in the U.S., which derive most of their earnings from within the U.S. They have not, seen the uptick that maybe some of the large technology companies have seen so far this year. So opportunities always exist. But I would say if it's been a while since you've taken a look at what kind of long-term return you need in order to make your plan thrive, this is a good time to do it.
Okay, great. Well, this has been a great discussion, and I thank you all for being here for this roundup of most popular questions on rate cuts from around the internet. And for the viewers, check out the Advisors Corner section of usnews.com. It's a real gem, and more articles and advice from our presenters today. So thank you, and we'll see you soon.
Thank you, Rachel.
Thank you, Rachel.